In financial statement analysis, there are three major questions for us to respond. First, what information should be used for financial statement analysis? Second, where do we find the data for financial statement analysis? And third, how to do the financial statement analysis, or in other words, what techniques or tools to use to conduct the financial statement analysis. Let's respond to the first question. What information should be used for financial statement analysis? To conduct a financial statement analysis, we need to identify what information we need in order to complete our analysis. First, we need to find information about the company's assets, liabilities, and equity. Second, we need information about business's revenues, expenses, and income. We need data on cash flows, whether the firm generates that cash flows from operating activities, investing activities, or financing activities. We should find that information too. And we might also need to find additional data from different financial reports. In each stage of financial statement analysis, we will dive in and understand better these and many other items that we need for analysis. If you remember, the second question we had was where to find the data for financial statement analysis. If we know what information to find, well, where to find that information? We should find the information about company's assets, liabilities, and equity on the balance sheet. It is well known that balance sheet provides a snapshot of company's assets, liabilities, and equity at a specific point in time. For example, at the end of the year or at the end of the quarter. The information about the business's revenues, expenses, and income can be found in the income statement. We also call it profit and loss statement, or P&L. As we know, the income statement shows all the revenues and expense accounts for a given period of the time. It's not a snapshot at a specific point in time. It shows how much were the revenues and expenses and income generated during the specific time frame, a year or quarter. The data on cash flow comes from the statement of cash flows. The cash flow statement provides a more detailed picture of business's cash flows during an accounting period. In other words, this statement gives more details about the sources of cash inflows and the uses of cash outflows. The statement is divided into three main sections: operating activities, investing activities, and financing activities. For additional detailed information, we might consult the above mentioned three statements, or statement of shareholders' equity, other financial reports, or the notes to the financial statements. The last question in financial analysis is how to do the financial statement analysis, or in other words, what techniques or tools to use to conduct the financial statement analysis. This is one of the most important and time-consuming stages of financial statement analysis. In this phase, financial analysts conduct ratio analysis. That's a huge part of it. They do multiple-based valuation. In other words, valuation using comps. Very often, financial analysts even use more sophisticated tools of valuation, such as discounted cash flow analysis, or they use a payback period, internal rate of return, and other methods for valuation. And all these methods are based on the financial data. Financial statement analysis is critical in order to understand the performance of the business. Forecasting is another important part of financial statement analysis. If we want to understand what was the performance of the business, how business performed in the past, forecasting, we want to get an estimate how the company will do in the future. So we try to understand what was the past performance of the business and how it does right now in current situation, and based on its past and present, how it will behave, how it will perform in the future. So forecasting, as I said, is an important part of financial statement analysis, and it's used by managers, financial analysts, and investors to predict the future revenue streams, expenses, and also expected cash flows. Businesses also use other assumptions, other methodologies, pro forma financial statements, and scenario analysis, considering multiple possible outcomes. And many of us use that in daily basis. While financial forecasting for future period involves a great deal of uncertainty, the future is uncertain, it is still useful for businesses to make their best predictions, estimates, based on the accounting and other financial information they have. So we're going to work on these three questions that I mentioned. We're going to understand what information we need for our financial statement analysis. We're going to figure out where to get that specific financial data for analysis, and we're going to learn what techniques, what tools, what methods to use to conduct financial statement analysis. So I'm looking forward to dive in with you into financial statement analysis and receive outstanding results of your financial statement analysis. I'm looking to receive from each of you outstanding results of your individual financial statement analysis. Thank you, and let's get started.